Welcome again to the Money Corner. Tonight, we're going to talk to you about professionalism. I'm going to introduce three guests. I have a panel constructed tonight who will help you become a more astute investor by avoiding pitfalls. And let me introduce my three professionals and tell you how their varied backgrounds will fit into the tapestry of showing you the ways of avoiding the holes in the highway, potholes in the highway. I finally found the word. John Lisa, you may know. John is a CPA and a professional, an accountant who has offices here in Ridgefield on Bergen Boulevard. John Downs is a resident of Englewood, New Jersey. John is an author. John, thank you for being here tonight. And Gary Myers is an attorney in Parsippany. Gary, you've driven a ways to be here with us tonight, and I appreciate your being here. I want to give you a little synopsis about each of our guests. John is a CPA, and John and I work together frequently. And John, by the way, is an academician, has taught accounting at St. Peter's College in Jersey City. And we frequently talk about the things that investors have to do to comply with the complex nature of security law and accounting demands, particularly by the IRS. John Downs is an author and has recently finished a manuscript on how to choose a professional, how the investor would choose a professional. By the way, John also has a new book coming out. I want to plug it right away because it really looks interesting. Beating the Dow, a high-return, low-risk method for investing in the Dow Jones Industrial Stocks, but how to do it professionally. Right, John?
Yes.
And Gary is an attorney who deals with cases in the securities business. Gary frequently helps investors capture what I guess you would call restitution, where an investor has been abused by someone in the industry. In effect, he will help them get their money back, and perhaps more than that. Looking at this topic that I call professionalism, I guess, Gary, that you encounter many things in your practice that kind of upset you about investment practices, frequently by professionals. Now, how does you help your clients by getting money back, by going to court and litigating for them, but how would they avoid getting in the problem in the first place?
Well, Phil, I think that really the issue, of course, gets right back to the topic of your show today, and it's really in selecting your initial selection process. One of the problems that we encounter very frequently has to do with the telephone solicitation problem. Many people, rather than selecting a financial professional or advisor through word of mouth, by finding someone with a long-standing relationship and reputation.
Track record.
Exactly. Track record with someone that they know over a period of years. Unfortunately, there's a whole industry out there of people. I refer to them as the fraud merchants. And they're really contacting all of us, and I think these gentlemen will probably corroborate that even in your professional offices, you're getting calls all day long from people that really have only one interest, and that's to sell something to you and make a commission.
Now, John, this was the guts or the heart of the manuscript that you've been preparing about choosing a professional as an investment advisor, choosing a professional investment person.
Well, this certainly and more. I think the biggest problem is that people are intimidated by financial professionals. Financial professionals have grown in number. There are just so many people all claiming to do the same thing, all calling themselves essentially the same thing, but with different backgrounds and different degrees of ethics. And so I think people are just afraid to ask the right questions of financial professionals. And I don't want to say that they get what they deserve, but I think it's a lot of cases would be stopped short of the courts if people simply ask the right questions.
Well, now, John, in your practice, you frequently see some very poor results in terms of the losses that your clients assume, absorb, take.
Yeah, well, that's true. Many times individuals enter into some tax shelters that they think they're going to have certain benefits for, and then they realize with the changes in the tax law that they can't use those. Not only do they have the losses, but they may not be able to use those losses. Those losses are suspended. Or also, in addition to that, the particular shelter didn't work out necessarily the way it was supposed to. And I see that many times in the practice. Also, but I think the beginning stage is getting back to what Gary says about really being educated. Many times individuals go into these investments and they're not geared for them. The risk level is not for them. It's maybe for an individual that may have a certain net worth or a certain station of life, and sometimes they're marketed to the wrong individuals, and individuals blindly go into these investments.
Now, Gary, as an attorney, I mentioned before that you, in effect, get restitution. You get money back for people, and you sometimes are involved in class action suits. What is the basis? Most of us know about a malpractice case in the medical profession, but how does an attorney achieve that for the investor, where the investor was, in effect, either duped or a part of the decision-making in the first place?
Well, Phil, you mentioned the class action lawsuit. One of the devices that we frequently really have to use because of the tremendous expense involved is either a multi-party or class action device that enables us to effectively represent hundreds or thousands of people at the same time. And really what we're trying to do is to isolate the fraud. For example, the limited partnership tax shelters that John just mentioned, they've been rampant since the 50% bracket of the 80s came along. And that type of situation, often the people behind that, with a lot of expense and digging, we find out, for example, where they list glowing backgrounds where they're CPAs themselves or attorneys. We find out if we do a full investigative report on the individual that what he forgot to disclose was that he was maybe convicted in the 1960s of grand larceny and or some sort of federal tax fraud, was bankrupt in the 70s and has all types of securities violations and other things in his background. And we try to really uncover where it is that there was some misrepresentation or some failure to disclose an important fact to an investor.
Well, then the other side of the coin is if a company went into business and marketed a product and they were totally upfront and totally honest and they failed, that really is not cause for action.
That's correct.
But the cause for action is when we get into devious behavior, we get into dishonest behavior.
That's correct. But we find that there is a very strong parallel between the failures and some form of securities fraud. You're absolutely correct in that it's not necessarily a fraudulent investment if it fails, but many times it is. And it takes a lot of investigation and just a lot of hard work to isolate it and bring it to the court's attention.
But I remember, John, when you told me about your manuscript, we talked one day about the book you were working on, where you were talking about how to make the investor a little more savvy. One of the things that you bemoaned is the fact that most people can't really understand a balance sheet, can't understand an income statement, can't understand a prospectus.
Well, I think that's certainly true. Companies have gotten more complicated, and investment vehicles have become more complicated. But again, I think it's up to the public to say, I don't understand it, and therefore I won't buy it. This is going to force somebody either to explain it or to simplify it. And I think it's going to eliminate a lot of the problems.
See, my feeling, John, is that we ought to be, you can't teach everything in school, but I think this is the kind of stuff you have to start getting in on a high school level. Elementary accounting is just something that baffles most people. Elementary bookkeeping is something
that is true. Some individuals just, when it comes to accounting or finance, they just draw a blank. They're just not able to comprehend it. But I'd like to get back to just one area that Gary mentioned on it that is very important, I feel. A lot of people who go into some of these tax shelters, not to belabor that point, now what's happening, because the real estate market has turned around and they're restructuring these deals, people are finding out that there's a lot of forgiveness of debt. And as anybody knows from basic taxation, that when you have forgiveness of debt on these real estate deals, there's income. And I found this past year that a number of clients through these limited partnerships have had a whopping amount of income due to the forgiveness of debt. The way a tax shelter has worked traditionally, and which was unexpected at this point in time, a tax shelter is basically a big leverage. You have X dollars down and you have a big mortgage on the property, and you're able to increase your basically increase the basis, and through depreciation and write-offs, deductions, you have a tax loss. But that tax loss is really a paper loss. It's not a cash loss. And in the years when the brackets were 70%, 50%, you utilize those losses. Then came the Tax Reform Act of '86, and it pretty much killed tax shelters. Tax shelters, after 1991, there'll be absolutely no benefit.
Will this forgiveness of debt still carry on, though?
Well, if they keep restructuring the deal, like properties that they had anticipated would be worth, let's say, $20 million, and the fair market value is much less than what the debt is on them, they have to go back to the banks and to the mortgagee banks and restructure the debt. And I'm finding that there's a lot of debt recapture, a lot of some income recapture. I had one where one client is it's out in Pennsylvania, in fact in the city of Philadelphia, that I would say the total partnership the partners must have taken in about $2 to $3 million of, quote, what you call phantom income. They didn't receive any cash. Then you break that out by 100 partners and you can see what the effect is on their
So in effect then, the partner, the limited partner, can have a big new obligation that he never anticipated, which could cost him a lot of money. So it's a whole new, an additional outlay over and above his loss.
That's possible. That is possible. But in my case, I'm saying the debt has been forgiven. In other words, the properties are worth less. You go back to the bank that's holding the mortgage because you can't meet the mortgage obligations and restructure the debt. So you're taking into income that difference in the debt, the debt restructuring.
Gary, you start responding to this. Does it?
Well, it certainly it rings a very clear bell. We see the same exact thing with our clients who we're representing in limited partnership programs. In addition to the fact that they discover that they're out their investment monies, they then find that in addition, the tax losses that they thought they had are frequently disallowed and turned into phantom income. So not only do they fail to get the tax deductions that they thought they were going to get, but they either lose them outright and in some cases wind up with this phantom income, which it's hard to explain in a short program like this, but I know John is absolutely correct, and that phantom income is devastating to someone who suddenly finds out that they got nothing in their pocket, but they have to declare a couple of $100,000 in income and pay tax on it.
I've seen that situation this past tax season where K1s have come in from these partnerships, and I knew there would be some phantom income, but not as much as I had anticipated. And not only that, there's also a state problem, because depending on where these partnerships do business, most states require that the partner, even though the partnership is doing business in that state, the partnership files an income tax return with the state, whatever state it may be, Illinois.
Fellas, let's hold this topic for a moment. We're going to break for an announcement, then we'll come back and we'll try and pick up and explain this phantom income. It sounds kind of complex and scary. We'll be back with you in a moment.
Okay.
Thank you. Thank you for coming, staying with us and being back. Let me reintroduce my guests again. And we're talking about professionalism. We're talking about how to avoid pitfalls, or potholes was the word I was looking for before. But my guests tonight are John Lisa, CPA. John manages an accounting practice in Ridgefield, New Jersey. John Downs is an author and a resident of Englewood, New Jersey. And my traveling guest tonight is Gary Myers, G. Martin Myers from Parsippany, New Jersey, an attorney who specializes in both class action suits and representing investors in cases where there are either fraud or a kind of financial malpractice. We were talking a moment ago, and John, you got in this complex area of phantom income with the partnerships. But over and above unforeseen problems with tax shelters, and we've had changes in the tax laws, in some cases they're kind of mitigating circumstances. But John, you have looked at the investing world, and you've had a world of experience in the investing world, where professionals, in effect, may not misrepresent, but certainly they kind of lead one down the garden path. and investors go astray?
It's a business of statistics. And wherever you have statistics, you have the opportunity for chicanery.
What is it, 12 inches of water? It's difficult to drown, but you can do it?
The Disraeli said there are lies, damn lies in statistics.
Okay.
But, well, I got something in today's Mail. Today's Mail. You should mention it. I read half of one sentence. This is a very prominent brokerage firm. It said, since 1975, our such and such fund has, and I didn't read any further, because 1975 was the worst bear market in 30 years.
The bottom of the trough.
Yeah. Anybody starting there could
Has to look
show
good.
dramatic results, of course. I want to know, and I think this should be the test of anybody that claims to manage your money, how much capital they preserved in 1975, 1974, 1975. That's the real question. And I think it's downright mischievous to market anything as important as investment services that way. It's a very prominent firm. It goes on all the time.
Well, but once again, it also illustrates this naivete or this total lack of sophistication on the part of investors. And that's the thing that I find scary. I'm here as the MC and not as the resource person, but I've got another example of what I call a blatant kind of malpractice. I know of a client, my client, who has their money in the hands of a money manager, and they pay a lot of money to that money manager. That money manager has had the money in the money market for 3 or 4 years now. Nothing but the money market, and charges a large fee annually. Now, that's pretty bad. And of course the question comes up, why doesn't the client do something about it? Why doesn't the client holler? And I often wonder about it. In this case, it's a person who really doesn't look, doesn't think, and is rather unsophisticated, but revels in the fact that their account is in the hands of a distinguished money manager.
That is certainly wrong, but the very talented fellow that I'm writing my current book with, he was so kind to plug, says that the hardest thing a money manager can do is do nothing. In most cases, a well-selected stock treated with patience and discipline.
I agree with that. Yeah.
Will grow in value.
Knowing when to hold and not to sell.
The problem is too much activity to justify a fee rather than too little activity and a fee.
Yeah, if someone had the astuteness to buy IBM 30 years ago and never sell it, they're far ahead of any in and out.
It's an extreme example. I think, with due respect to present company, most brokers, and this is not to talk about churning, but many brokers trade more than is probably necessary. If most brokers analyze their trades over a period, they would probably have to conclude that a good many of them would been better left undone.
That raises an interesting point. At Merrill Lynch, and as the people on this program know, I've been with Merrill Lynch for 29 years now. That's well known. We now get we get so many statistics thanks to the computer. We now get a printout which shows us our ratio of turns in relation to our assets. And you can see whether it's high, whether it's low. And I know some brokers who really are underactive. They're not aggressive enough. And that can hurt a client as much as over-aggressiveness. So I guess, as with anything else, there's a point of moderation or a point in between. Gary, I'm somewhat surprised. I had expected, you've talked about the class action suits. By the way, would you quickly tell us how you identify and get the class in a class action suit? Mechanically, that must be difficult.
Well, sometimes it's very easy. It really depends on the situation. But for example, if we're talking about limited partnerships, as we've repeated here, for example, in the tax shelter area, many of these were essentially Ponzi schemes, I think was a term that John used. And basically, there were so many of these things marketed in exactly the same way that it was pretty easy to identify when they started falling apart the investors who were...
But how do you get the list? How do you get the list to do the mailing? I know I've seen the mailings. The mailings come out from a court.
Well, with class action lawsuits, there is a mailing eventually, and sometimes you can
To all the holders.
to all the holders.
I
Sometimes
see.
you can get that either from the company involved, a list
Or
of
by,
shareholders,
or by court order.
or by court order. Also, many of the lists of people who are invested in certain vehicles are filed in county clerk's offices in various
I
places
see.
around the country.
That was not my primary question. I'm a little surprised that so far you would have not talked to us about restitution in the case of churning. My assumption is you've had that in your practice.
Well, just when John mentioned the churning.
And would you like to identify the term for
Yeah,
us?
I think we should
define the
do
term?
that for your viewers. Really, that's the extreme of the example. The other extreme of what you were talking about. They're doing nothing is on one extreme, and churning is the name that we give for excessive trading. And as we're sitting here, I'm thinking of a case I handled recently where I represented a widow, a very lovely woman who had teenage children at the time that her husband unfortunately passed away, found herself with $70,000, $80,000, or $90,000, which she had neither the knowledge nor the emotional wherewithal to know what to do with at the time. She did what she thought was intelligent, actually went, in this case, again, to a very legitimate brokerage company. It was not the company that you're with, I'm happy to say.
Thank God.
But it is a very legitimate, well-known company for the most part. But the particular broker who took over her account was not so legitimate. And when she finally came to me with this case, she came with a bag of trading tickets that took us about 3 months to sort through. And that was a classic example of the type of churning problem that John first alluded to. And it's something that can really cause some serious losses. Fortunately, here we were able to get back at least a portion of what she lost. And
Of course, I think the general public should know that our industry does have a formal arbitration mechanism run by and with the New York Stock Exchange, and some people question whether it's in the best interest of the consumer, but it has been upheld recently in a case before the Supreme Court. But they do hear these kinds of cases, and they can order restitution without necessarily going to an attorney. Many people do go to an attorney, and interestingly enough, I think very frequently the consumer does prevail. I think the firms are not interested in getting these suits, which can be costly to them in terms of their public image.
actually, sometimes it's a good point, because sometimes people can avoid the necessity of legal action by a well-timed threat. Because some of these companies do want to avoid the exposure. But unfortunately, we find in too many cases that they just don't respond where you'd think good business sense would dictate that they should.
One of the things I thought, John, you might allude to tonight, and I think should be brought out, and that's, you know, I'm a big advocate of the cash management account in terms of the way the computer defines and bookkeeps every aspect of a securities action now. And one of the things that we find so frequently, people don't know when they bought something, what they paid for it. It's impossible to do a tax return. And I think the way spreadsheets are working now and the way retrieval through the computer are working now, as this data gets on paper and is in black and white, it makes for better investing. I had a good friend who was a senior executive in a major corporation, and he handled that corporation's very, very large pension fund. And he said it was amazing to him, as soon as he made his subordinates do nothing more than record every detail precisely on paper, the investment performance started to go up. You know, it was a subconscious or a subtle kind of tracking mechanism. And I think that the computer is a big help in that sense.
Yeah, I definitely find that, you know, our mutual clients, you know, receiving those monthly statements from Merrill Lynch, you can review them to see, you know, whether or not the client may have too much money, cash on hand, or or you know, which basically you do in managing it. But I do find that it gives you the total picture, and you see where they're going.
It also shows you cash flow. It shows you whether they're spending more money than they're taking in, whether they're taking in more money than they're spending. It's an accounting system, and I think that ultimately will make. By the way, it also shows percentage returns on investments. And I think this will make smarter investments if people learn how to read the darn statements, which is another problem by itself. John, in your manuscript, have you dealt with any little rules of choosing an investor? Certainly, I think Gary stated at the beginning, we don't want to fall for the telephone. Hello, I'm Charlie.
You would choose the investor.
How to choose the
reader would choose an investment professional.
Yeah, how to choose the investment professional.
Yes, I have.
By the way, I do choose investors. I want you to know that. There are many people I won't do business with. I'm not looking for headaches.
I also know you to be an excellent broker. Yes, my first order of advice to anybody is not to misunderstand what a given professional does do. I mean, a broker is not a portfolio manager. Many good brokers perform a service that's tantamount to that, but it's not their basic function.
Right.
And that's very important to understand, is often confused. Money managers are the people paid to beat the averages. And again, I think that's all about consistency of record and continuity of personnel. It's a very entrepreneurial business, money management. It's intuition, it's skill, it's consistently applied discipline, and
it brings to mind the man from, is it the Magellan, is it the Magellan Fund?
Yes.
Who just left?
Magellan
Who's that?
Fund.
Lynch?
Peter Lynch.
Compounded money at 29% for 10 years. Remarkable.
Yeah. Isn't that remarkable?
With $13 billion, which
Yeah.
is also incredible, because the size, it becomes more difficult because you have to be in stocks that can be easily bought and sold, and that limits a huge portfolio to very few stocks. So Mr. Lynch is to be congratulated for his excellent judgment in deciding when to quit, I think.
We're almost at the end. I have one rule of thumb that I think the average investor or any person who's going to commit capital should follow. That's request an appointment and go in and quiz the person. We have a lot of women in the business now who are very, very capable, and tell them, what is your style? What do you invest in? What is your track record? Demonstrate it, and give me 3 referrals. Now, we got 30 seconds to go. I have some clients I'm delighted to give referrals because we've had an experience with each other, good markets and bad, over a period of a couple decades. And it's one way to do an evaluation of a profession that essentially is an art, not a science.
Make your own objectives very, very clear.
Yeah.
I think that's key.
Well, thank you, John Lisa, and John Down, and Gary Martin, Myers, coming a long way from Parsippany. I'll be back here on the Money Corner with you soon
Denville,
again. Denville? Oh my God! I must have said Parsippany 14 times.
That's fine.
Why did you stop me now at the end? Thank you for coming from Denville. The people in Parsippany will forgive me, or Denville will forgive me. Good night. See you again soon.